So the stock market dropped today. Dow got hit by about 200 points. The gold and silver got beat up pretty badly. The only news I saw there is Trump came out and said that there would be no tariffs on gold. I don't believe there was that much fluff in gold, believing that it was going to be tariffed. Again, love to get your thoughts and comments. The cryptocurrency market got beat up, rallied yesterday, and then gave a lot of it back today. The 10-year yield was up a little bit. But very, very, strange day with the markets and with news events. We have the CPI numbers, I believe, being released tomorrow. See the markets react to that. Before I get started with today's discussion, I want to ask that you guys please hit that subscribe button for me if you enjoy the content. It's free, and what it will do is automatically then notify you guys when I upload new videos. We're getting a lot of people watching the videos, not all the way to the end, but watching them, but it's not translating into our subscriber base. I would like to see that happening. Just real briefly, YouTube says that between 2 and 10% of a channel's subscribers actually view the videos. We're getting like 60, 70, 80, sometimes hundreds of percent of our subscriber base actually watching the videos. So I really like it if you guys would hit the subscribe button for me. So again, on my continued effort to bring to the forefront the problem, as we all know, with the debt in this country. Real briefly, I saw that the household debt report was released by Wallet Hub. And it says the average American household is more than $150,000 in debt, with mortgage accounting for more than 2/3, it says, of what's owed. And you might say, well, look, that's really not that big of a deal, because most houses in this country, average house price is over $400,000, of which most people finance at least 80%. So, but here's the concern. It says the current 18.39 trillion in total household debt equates to an average, like I said, 152,000. In line, it says, with the average household debt since the start of 2020. However, the inflation-adjusted record for average household debt in the fourth quarter of 2008 was 166,000. So we're getting very, very close to reaching the point that it was inflation-adjusted debt per household going back to 2008. And we all know what happened to the economy and to consumers in this country following 2008 and the great financial crisis. Mortgage debt does account, it says, for 70.4% of the household debt in this country. It's also includes the remaining 30% is which is auto loan debt, student loan debt, and of course credit card debt. Buy now, pay later debt is still not figured in to the calculation. And by the way, this $150,000 number is personal consumer debt. It does not include the additional six figures or multiple six figures of debt owed per person in this country that translates or relates to the federal debt, right? The debt, the $37 trillion that the United States is in debt. So I think that's a very, very important metric to watch, because everyone's saying, well, foreclosures really aren't spiking that much. Defaults really aren't that historically high. But when you compare, when was the last time we had this much debt, these many people struggling financially? We got to go back to just before the great financial crisis. Next thing I want to share is having to do with the younger people in this country. They need to figure out this disaster now. And out of Fox Business Today, young Americans drowning in credit card debt as delinquency rates climb near 10% in Q2. It says young Americans continue to make up the largest share of those transitioning into credit card delinquency in the Q2 of 2025, according to a report released by the New York Federal Reserve. Despite ticking down slightly from the previous quarter, it showed nearly 10% of credit card balances held by Americans aged 18 to 29 became 90 or more days overdue in the Q2. And so the credit card delinquency rates for Americans under 40 have been unusually elevated, adding they are keeping a close eye on the trend. If you go 90 days late on your credit card, number one, it's already been reported to the National Credit Reporting Bureaus, and it's going to have a negative impact on your credit. Number one. Number two, if you're 90 days late, you're probably getting your credit line frozen and then reduced by the credit card companies, so you can't use those cards if you do need them for actual necessities and not just, reckless spending. And number three, you're not going to be able to get any more credit. You're not going to be able to buy a house when the time comes to buy a house for you and your young family, because you're going to have negative credit marks, negative marks on your credit report, or that category of folks are. So I don't think they understand the real consequences of this. It is important that all of us that are in watching this channel, including my people my age group, 45 and older, start to do our best to educate the younger people about the financial responsibility that it takes, okay, so that they can hopefully partake in the ability to succeed later on when it's going to be really important for them. It says the rate of balances transitioning into serious delinquency for 18 to 29-year-olds has hovered around the 10% mark since 2023. And again, before then, the last time the rate, sorry guys, it's really warm here in the desert today, and I have the air blasting in my office with a fan, and it still says 83 degrees in my office, so excuse me. Says the last time that it got this bad was in 2010. Again, going back to the period of time in the great financial crisis. It says most buy now, pay later lenders do not report payments to credit bureaus, and usage of the buy now, pay later was much higher among younger borrowers compared to those in other age groups. Researchers said their findings suggest typical buy now, pay later purchases were fairly small, between $600 and $1,000. What we're hearing now, it's extended to even smaller purchases, like even a cup of coffee. The report comes after data painted an increasingly shaky picture of the financial security of members of Gen Z, that age group I just described. A separate report by the New York Fed found unemployment rate for recent college graduates aged 22 to 27 had spiked from post-pandemic lows and is 0.7% higher than the national rate as of June. Excluding the pandemic, the unemployment rate for recent college graduates in March of this year was the highest in more than a decade. And I just saw a quick headline out of Fortune that says more than half of industries are already shedding workers, a telling sign that's accompanied past recessions, top economist says out of Fortune. So a lot of these, I say, kids, young adults are coming out of school, as we know, with massive, student loan debt, unable to pay that. And now, the job market, the labor market in this country is extremely challenged. Half of industries, more than half, are cutting workers. So those industries, are not hiring. They're actually pulling back and they're eliminating positions, not to mention what the impact of AI is going to have. So I don't want to go too long today. It's disturbing, and the younger people, the younger adults need to get their what together and figure this out. Even if it's just making the minimum payment timely, a lot of it they just aren't. A lot of it is just irresponsibility, not the inability to pay the $29 or whatever it is, $39 a month minimum payment. okay? So please, guys, spread the word on this. If you have, younger children, grandchildren, great-grandchildren, we've got to do our part. It's getting bad. Thanks for watching. If you like the content, please, again, hit the like button and subscribe to the channel so we'll keep growing. With that being said, again, I welcome your comments and thoughts as always, and I will talk to you soon. Bye.